Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate. Well, today we're going to look at the U.S. office market. We'll look at current market performance. We'll look at the trends affecting the market and what to expect moving forward. We'll also discuss strategies for tenants, landlords, and investors. Please welcome my first guest, Ryan Severino, Senior Economist with REIS. Thanks for joining us, Ryan.
Hello, Michael. Thanks for having me back. It's always my pleasure to be on.
Well, we appreciate it, and we'd like to ask you, how has the office sector performed year to date overall in the U.S. so far this year?
You know, the sector's been performing okay this year. Vacancy through mid-year was about 16.8%, which is, certainly a bit elevated, but is down from the cyclical high that we reached a few years ago. Rents on an asking basis have grown by about 1.4% this year. Effective rents have grown by about 1.5%. Both of which are actually the fastest rates of growth through mid-year we've seen since the market began recovering in earnest in 2011. Net absorption through mid-year is also tracking better than any year since the market started to recover. So while I'd say the market's not yet where we would need or really like it to be, we are clearly trending in the right direction. Well,
that's good news. That's very good to hear. And will this trend continue? What do you expect to see moving forward?
I actually expect things to improve. In fact, I expect the rate of improvement to accelerate in the coming years. Vacancy compression, rent growth, net absorption should all be improving at an increasing rate as the economy improves, as the economy continues to create not just more jobs, but especially for the office sector, more office-using jobs. And I think we've been seeing that more and more in the data in recent months coming out of the labor market. So, knock wood, barring some kind of idiosyncratic shock, we expect the economy to continue to improve, create office-using employment, and that will translate into better fundamental improvement in the office market over the next couple of years.
Well, that's great. Can you see me over the phone? I'm doing the Snoopy dance. Well, real estate always is local. Do you see any significant differences between A and B class property performance or suburban versus CBD?
I'd say generally speaking, Class A continues to outperform Class B by a fairly significant amount. Class A vacancy's fallen about 150 basis points from its peak, while Class B continues to struggle a little bit looking for demand. I'd say CBD continues to outperform suburban office space, although there are actually some signs of life out there in the suburban market, sometimes in some unexpected places. For example, believe it or not, suburban office in Phoenix of all places has seen some signs of life with a number of call centers that have been moving in over the last year or so. And I think at this juncture, improvement in the submarkets is a little bit idiosyncratic as opposed to anything more systematic, but like I said, there are definitely signs of life out there. And I think the key is that we need to see small to medium-sized firms ramp up their hiring, which has definitely been an upward trend in the labor market data over the last, say, 6 to 9 months. That will really help the suburban submarkets because it's really those small to medium-sized firms that are the primary users of suburban office space.
Right, that's a good point. And you think if everyone believes that the office market is continuing to improve, that investment sales volume would improve. So what do you see for investment sales volume so far this year and for cap rates?
It's funny. This year, we've actually seen a bit of an improvement in terms of sales volume. The data is not quite finalized. I think, we always have that thorny issue with the non-disclosure states, but we do see continuing, I'd say, increasing interest in the office sector. I'd say even in terms of, if you look at pricing on the cap rate side, cap rates, for, let's say, Class A properties are probably down sort of the mid to high 6% range with, the best properties are obviously trading well below that. But even the BC properties are only marginally higher, probably in the low 7% range. And so, I would say in terms of volumes, we're still seeing volumes below what I would consider to be more normal activity, and not even just sort of the bubblicious volumes from before the downturn. But, interest is starting to come back a bit. Volume is starting to drift higher over time. Pricing is still, 6s to 7s is not so bad given the ongoing weakness in the economy that we've been seeing. So I think things are sort of like fundamentals. They're improving, but the pace of improvement I think is still a little bit marginal right now.
Right, and we're seeing the same thing. We sell office buildings in the Southeast, and we're starting to see a lot more activity on the B product, and in some of the smaller markets, I think people are feeling a little more confident. And I think one of those reasons is the lack of new construction, right? What do you see for new supply levels out there, and how do these supply levels compare to normal years, if you will?
I completely agree with you on that. This year in our major markets for competitive market space, we'll probably see somewhere in the neighborhood of only about 23 million square feet delivered, and that's across the largest, say, 82 or so markets in the country. This is well below long-term historical trends, which is more like 50 to 60 million square feet in our major primary markets. And so over the next few years, we definitely expect construction activity to inch back toward normalized levels, but it is going to take a few years to get there, and we are definitely not there yet. So I think the lack of construction activity in the market is definitely a catalyst for interest on the part of investors, especially as they start to train their sights away from apartment, which has been the darling of commercial real estate, toward other property types that offer maybe potentially better benefits over the next few years.
And what do you expect for cap rates and values of office properties moving forward? If we're bullish, we think it's going to be an improving market, but yet we could have some slight interest rate increases, right? What do you think for cap rates and values moving forward?
I think over the next few years, office cap rates will continue to drift slowly downward. Now, we've seen a lot of cap rate compression over the last few years, so I don't expect to see that kind of breakneck pace. Now, obviously, that was a very selective marketplace, but I think it's starting to affect pricing. That said, I do expect to see cap rates probably drift a little bit lower. I think with the economy continuing to recover, generating more office-using jobs, that's going to translate into NOI growth. And as NOI growth starts to ramp up, risk premiums, which are already fairly low for good quality office properties, that risk premium will translate into other properties that start to participate in this recovery. We'll probably see them compress a little bit. And I think investors are going to become increasingly more interested in office, which is going to put downward pressure on cap rates, even as interest rates start to rise. I think what you see is a little bit of a tug of war between NOIs and risk premiums and cap rates. And as long as the economy cooperates, there's no reason why cap rates, at least over the next few years, shouldn't drift a little bit lower than where they are today.
Okay, well, that's good news for a lot of owners. So if I'm out there and I have $50 million, and of course I do, right? And I want to buy and invest in one of the top three markets. What are the top three markets where you feel in the U.S. that'll have the most rate increase, the most occupancy increase in the next few years?
It's a little tough at a lower price point, but over the next few years, the strongest markets are going to be some of the ones that we know of. New York, D.C., San Francisco, San Jose, places like that, both in terms of low vacancies and strong rent growth. So there are opportunities across the price spectrum. The problem in markets like those is that on the fundamental side, things look good, but of course, one has to pay in order to get into those markets. And so it's sort of a good news, bad news kind of thing. Good news is that those markets will continue to be strong and generate the best rent growth over the next few years. The bad news is it's still a little bit pricey to get into those markets.
So I'll need $500 million.
Yeah, maybe.
Well, let's talk about opportunities. If we see some rent growth and some occupancy growth coming down the pike, where might there be some other opportunities for investors?
So markets that are a little bit off the radar screen, places like Charleston, Greenville, even Chattanooga, Louisville, Omaha, that are starting to see an improvement in fundamentals will become relatively more attractive to investors going forward.
All right, those are good points. Ryan Severino, thanks for joining us today. We appreciate it.
Thanks, Michael. Always my pleasure.
If you'd like more information from Ryan and REIS, visit REIS.com. That's spelled R-E-I-S. For more information, you've got to check them out. Stay tuned for more office sector intel. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Florida International University and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.